Hi, everyone. Thanks for letting me on here again. Great to be with you again. I'd like to give you some of my views on the gold market. And as you can see, my view is we're in a new metals bull market, specifically a gold bull market that will kind of drag everything else along it. So I have a number of slides here I'd like to go through, and I'm going to go through them pretty quickly and try and summarize the situation as succinctly and hopefully as compellingly as possible. But we all know what's going on. The COVID-19 pandemic has created a dramatic economic uh, downdraft globally around the world. And my view, and a lot of people share it, is that this was merely the pin that pricked a massive existing bubble. What has happened in response has been extraordinary. The policy responses from central banks and governments has dwarfed anything seen before, not only in speed, but also in degree. Here we see a sign of that. We see total Fed assets. They absolutely exploded. You can see that they started off actually last August, a little over a year ago, a little less than a year ago. At the end of August, they started some form of quantitative easing at the Federal Reserve, but then really took off in March as they responded to the economic slowdown as a result of the pandemic. You can also see right at the peak, it's actually slowed down a bit and decreased. The Fed buying has dropped in the most recent week by about 73 billion, or their total assets have dropped by about that much. I think that's merely a blip in the run up. And what we're going to see is that by the end of July, some of these fiscal programs in the US, these stimulus programs, will run out. And over the next couple of weeks, we're going to see the bidding war in Congress in the US begin and accelerate as they start to write blank checks again. And I think that will be the impetus for another rebound in the markets, the gold markets. But as we can see from this chart, which combines or compares the the Fed's QE programs, both post 2008 and post pandemic, you can see that the current COVID-19 is labeled on here, quantitative easing program, dramatically outpaces and dwarfs anything ever done before. You can see QE1 is the gold line, QE2 is the green, and then the blue line, which was QE3, which was essentially unlimited quantitative easing. The Fed immediately shifted, immediately went to unlimited quantitative easing in response to this crisis. This is the kind of thing that I had been predicting that they would have to do in the next economic downturn. What I and no one else predicted was to see something that we expected to develop over 3 to 5 years essentially happen over 3 to 5 days as the Fed really just immediately went into ultimate quantitative easing mode. So this quantitative easing infinity was immediately supplemented from the central bank side of the equation. They immediately went to the fiscal side, and we saw helicopter spending. That term has been in vogue or popularized for a number of years in regard to what the Fed could do. Nobody really thought at the time that they wouldn't need helicopters. They could just direct deposit, which is what they did. The result, of course, has been an absolute explosion in federal debt, as we see on this next slide. The national debt, the federal debt, is about 27.5 trillion right now. Interestingly enough, that's up 500 billion over just the last month, and it's accelerating right now. The federal debt to GDP ratio is 132%. That was around 103 to 105% for a number of years in recent years, and kind of held steady there as the GDP actually grew. What we see happening now is that spending and the debt is exploding to the upside, and the GDP is actually declining. So that number, which is critical, is exploding to the upside as well. As a point of reference, the World Bank and a number of other institutions regard a federal debt to GDP ratio of around 70% as a warning sign. And now, as you can see, we're at 132% in the US. So what are the implications of this massive debt load? Simply put, it's ultra low interest rates forever due to the costs of servicing the debt. The debt is so large at this point that if we had real positive interest rates of any significant degree, then the debt service cost would just explode the federal budget. So the Fed, for a number of reasons, and as long as it can control interest rates, will have to have ultra low and even negative real rates of interest maintained. And of course, gold loves that. Gold loves negative real rates. As you can see from this chart from our good friends at Incrementum, who put out the In Gold We Trust annual report, the blue areas indicate periods when negative real rates maintained. As you can see, the gold line is the gold price. And whenever we're in those blue shaded areas, when we had significant periods of negative real rates, the gold price outperformed. We will again have negative real rates going forward for essentially as long as this monetary regime remains in effect. Now, if you look back, I think there's a great lesson that we can get from the 2008 crisis, even though this is proceeding much more quickly than we saw post 2008. Essentially, if history doesn't repeat, we don't see precisely the same kind of progression that we saw in 2008, it's going to rhyme fairly closely. And that's instructive for the kind of bull market I think we're about to see. So let's take a look at that. If you look back at the 2008 financial crisis, you can see that just as it began, he had tremendous declines and updrafts and declines again in the gold price. Just absolutely remarkable volatility. The price would go up $100 over the course of a couple of days and down $100 over the course of a couple of days. And this was massive liquidity driven selling when investors and speculators had to sell anything that wasn't nailed down to raise capital to meet margin calls and the like. That's what we saw at that point in time. And then we can see that post that reaction, as investors started to respond to the policy responses and realize what those meant, all those federal programs, quantitative easing, all these unprecedented steps that the Federal Reserve was taking, investors started to respond to that and they started to buy gold. As you can see in this chart, after the financial crisis, fear turned to greed and investors were buying gold in reaction to unprecedented monetary stimulus. From these lows of around $700 or thereabouts to the highs of over $1,900, the gold price nearly tripled over the next couple of years in response to this extraordinary level of monetary stimulus. That essentially is what we're going to see right now and what we're seeing. And let's take a look at that. Let's take a look at where the metals are now in this crisis. Here we see a chart of gold over the last 6 months. And as you can see, we had that severe downdraft in early to mid-March. Tremendous liquidity, again, a liquidity-driven sell-off where the gold price was taken out to the woodshed. But then we saw a very swift, very similar to post-2008, we saw a very swift rally up to the high 1700s. But then from about mid-April till just recently, gold was trading in a range, kind of digesting that big move up from mid-March. We've been trading in that range, and literally over the last couple of days, and as you're watching right now, we've broken out of that range. That key resistance point was around 1780 to 1790. And gold has actually popped right back over $1,800. This chart is about a day old, but gold on a continuous contract basis has popped back over $1,800, and on a spot basis, is nudging right up against that mark. So this is a crucial area from which we can expect and hope to see a breakout going much higher. And frankly, after this, after it gets past $1,800, I think a rise to over the previous record of around $1,920 is very much in the cards and could happen very quickly. Looking at some technical indicators that I like to follow, one of these is the 14-week stochastic. As you can see down here in that black box, the stochastic, which is a measure of momentum, remains in the upper half of the range, and specifically above that key 80 level. And that's what we want to see. If you go back to the 2004 to 2007 range, when we saw just tremendous gains in gold and the associated investments like mining stocks, the stochastic managed to stay above that 80 level without any significant pullbacks for some period of time. This indicates sustained upward momentum, and that's really what we like to see. And again, that's what we're starting to see, this kind of pattern once again. I'd like to bring your attention to the Bollinger Bands for gold. As you can see, they compressed or pinched. That indicates a period of lower volatility. Going back to my slide a couple of slides ago, when gold was trading in that narrow range, the volatility collapsed. What happens is that gold, or really any commodity or any asset that shows this kind of a pattern, when you have this extended period of low volatility, these bands compress and they predict or foreshadow an increase in volatility. Bollinger Band squeeze has formed once again. And when you're in a market that's on an uptrend, like gold is in right now, this is another technical indicator that's foreshadowing or predicting a significant breakout in gold to the upside. So the bottom line, a new gold bull market is in progress right now. I think that investors have seen that not only in the gold price, but in the mining stocks. The junior mining stock market is absolutely on fire, and we'll be riding the rise in the precious metals much, much higher. Let's try and get a look at what kind of potential we're talking about right there. Here we see that gold has huge upside in real terms, and this chart shows gold's price peaks in today's dollars. So if you go back to 1980, January of 1980, we remember that the nominal price record for gold was $850 back then. Well, in current dollars, that's over $2,800, or 1.86 times the current price. If we just go back to the peak in 2011 of $1,920, in current dollars, that's $2,142. So that alone is a 42% gain, just to equal the previous record of 2011 in real, constant, inflation-adjusted dollars. So that's a lot of potential for gold itself. Now, if we get to silver, we have huger upside, as I call it. For gold to get back to its price peak of $50 in 1980, that's equivalent to $158 in current dollars. That's a 9 times multiple. Even if gold gets back to its price of $55 in April of 2011, we'd see a 3 times increase in silver. So gold has a lot of potential. Silver has a natural leverage to gold and naturally more upside. Now, a lot of people play the junior mining stock market, and there you have all of these factors plus the potential for discovery. That's one of the reasons why we like to focus in Gold Newsletter on discovery stories, because that gives you a lot of attention brought to the sector or brought to a particular stock because of a gold bull market or a silver bull market. But then you have the added potential, which can be explosive, of actually finding something. Here we see an example on that, which I call hair on fire upside, or represented by junior mining stocks. One of the biggest winners in recent history, a generational discovery, was Great Bear Resources. We picked that, one of the first people, one of the first newsletters to get our readers onto that. And that stock is up 55 times from our entry price in a gold newsletter alert. So this just gives you an idea of the kind of explosive upside potential in junior mining stocks, in the best ones, the ones that are about to make a really big discovery, if you can find them right before they make that discovery. So that concludes my presentation for you today. You can find me at goldnewsletter.com, the New Orleans conference.com. It's October 14th to 17th this year. And you can find me on Twitter as well. Thank you.